Which is why I'm so comfortable not putting, the house behind one specific trade, because I know that there's times where the market makers or whoever's out there is going to be chopping price up and down, trying to stop people out, try and get them to flip sides. And I've seen it too many times in my own trading where, I've been stopped out multiple times. The third time when I decide to reverse positions, that's the one that really goes. So you have to be somewhat stubborn in your analysis, but you have to make sure that you're not going too overboard, but you're too stubborn, you're too married to the bias. It's got to make sense. And from a technical standpoint, I'll always have invalidation levels. So after we created that swing point, that would become my invalidation. So unless we lose, it even can be as simple as this daily low. Unless we actually get a closure below one of those daily lows, I'm going to remain bullish if everything aligns with that.
What are your thoughts here? Don't you think there'll be a lot of people probably looking to sell from this fair value gap? Even though it's taking liquidity. What would your advice be to those people out there who, in this scenario, really should be looking at longs into this fair value gap, but instead they're actually focusing on trying to short from this fair value?
Well, it really depends on the overall range. So if this is a previous monthly low, you can imagine it's probably been running lower and lower and lower for a very long time. So if this is the previous low, this is our range right here. So if we go lower, right, that fair value gap now, that bearish fair value gap is appearing at the low end of the range. Whereas, let's say, we took out a previous monthly low, yeah, that's great. But in the overall range, maybe the range is much bigger. Maybe there's more previous monthly lows that is creating a much larger range. And if we're expecting maybe that previous monthly low to just get taken out, trade higher into that bearish fair value gap, and then trade lower, it has to make sense from a context perspective. So depending where that fair value gap forms is very important.
But then also the liquidity that sits below this point. Because let's say, as an example, let's take EU. When we hit those previous monthly lows a couple months ago, there was nothing left.
Yeah, there's nothing left.
So the only place really for it to go, even if it wanted to go lower, was higher first.
So when you're looking at something like this, when it's inefficiency or liquidity, it's just how much liquidity is left below or above. Usually when it's hitting those massive extremes, there's not much left, and all the liquidity has already been taken out of the market.